Good morning, good afternoon, and good evening, everyone. Thank you for joining. Welcome to the Refinitiv Evaluated Pricing Services Fixed Income Valuations Year-End Outlook webinar. First and foremost, on behalf of the Refinitiv Evaluated Pricing Service and today's participants, thank you for taking time away from your day and attending today's webinar. My name is Christina Rosales. I am the Client Relations Lead within the Refinitiv Evaluated Pricing Service. Joining me today are my colleagues from the team. As our moderator, Carl Mackelberg, Director of Fixed Income Valuations. We have also invited 5 panelists to join. They are expert evaluators across different asset classes. We have Steve Dix, Manager for EMEA Valuations, Fernando Gamio, Manager for Americas Valuations, Michael Hessian, Senior Valuations Lead for U.S. Treasury and Money Markets, Steve Martin, Senior Valuations Lead for High Yield Corporates, and Don Ojo, Senior Valuations Lead for Securitized Products Analytics. Before we get started, in terms of housekeeping, you can submit questions via the Q&A chat box. I will weave in your questions throughout the session with the panelists. And if we are unable to address all the questions today, we will look to follow up and address them via email. The slide deck today will be circulated after the webinar to all of our attendees. Today's agenda, we will be covering the following relevant topics that could impact evaluations. We will kick it off with our current market environment, specifically COVID, U.S. debt ceiling, and energy prices. We will then briefly touch upon China real estate, followed by LIBOR cessation, or more commonly referred to as reference rates transition. Then we will discuss home prices, specifically around mortgage rates and prepayments. And lastly, address early market closing dates and how your file deliveries are impacted. With that, I will now pass to today's moderator, Carl Mackelberg. Carl.
Thank you very much, Christina, and thank you everybody for joining us as we discuss some of the things that we are thinking about as we go into year end on the evaluation desk. I first want to start with Steve Martin and talk about the volatility due to Corona. I thought it was over. But we experienced that volatility again on Black Friday. So Steve, can you talk about what we experienced Friday and kind of contrast that to what we experienced in March of 2020?
Hi, Carl. Yeah, back in March of 2020, it was extremely volatile. So we're not seeing that same amount of uncertainty with the markets as we were back then. The markets were they were hit extremely hard during that time. Today, it appears like the medical community has a good handle on what's going on, and they're better prepared. I think. The symptoms seem to be a lot milder than they were. So it's not to say that we're not experiencing volatility, but to give you a little bit of an idea, high yield was down probably about 1 to 2% and has bounced back since then. The yield on the 30-year, kind of whipped around a little bit during that time. It was like a range of 1.67 to a 1.96, which was like about a 6-point swing in dollar price.
Do you think the market was susceptible that day because there not many people came into work? Not many people working today. It was a light trading day.
Well, that could definitely have an effect. You don't have all your main players in the market to handle that stuff. But still, I mean, it's news. It's something that it's a new variant. So I guess there is a little bit of uncertainty, but not like it was back then.
All right, let me turn it over to Don. Don, it seems like the markets feel like whenever there's volatility, the government will support it. The government will bail us out. Can you give us your opinion on that?
Well, I think that there's now a political consensus prior to 2020 and prior to COVID. I think the last intervention into the market that we saw is 2008 after the crisis. So I guess the discussion is now over as to what the governments will do, whether on the Fed side or on the fiscal side. It's now clear that government intervention is now a political consensus, and you had it during the Trump administration last year and during the Biden administration this year. So the discussion today will be, how to take off some of that stimulus. In mortgage markets, you still see the Fed still heavily investing in this market. They're purchasing roughly around 10 to $15 billion in transactions weekly. And we expect that to continue into at least March or June of next year.
Okay, thanks. And Steve in London, are you seeing the same government support over there?
By and large, I would say that we're seeing less government support, but this is much more of a mature QE program. The European Central Bank are continuing with their PEPP program, but they're debating the notion of pulling back on that into the 2022. In the UK, the QE program is largely done. The central bank is looking to, they're debating hiking rates because of the inflation profile in the UK. They certainly deferred last month. So I think it's much more of a wait and see process for central banks in Europe and the UK as to this latest Omicron variant. Certainly on the Black Friday that Steve was talking about, we saw sectors getting hit. So rather than, while the indices went down somewhat, travel and transport and leisure were more hit. So there's much more of a differentiation now, I think, as the latest version of this variant comes through the news wires. So much more nuanced, I would categorize it, rather than March 2020 when everything was just marked down quite aggressively.
Okay, thanks. And Mike, the variant, what effect did it have on the fixed income markets, especially the U.S. Treasury market, and have we rebounded since then?
Yeah, if you look at, I have a chart right in front of me here of the 10-year Treasury, yield, and continued spikes and dips, over the past few months. Different things impacting it, of course. But as you talked about on Black Friday, we were somewhere in the 1.6 to 1.7 level, and we're currently around the 150 level right now. So we have not gone back to that level yet.
Okay, and Fernando, what have corporate spreads done since that time?
Yeah, well, during Black Friday, everything was down at a point because we opened the market with a treasury yield at 160 basis points, went down all the way to 147, 149. We observed some of the retail and hospitality sectors widening 15 to 20 basis points. They've recovered since then, not quite to pre-Black Friday, but not far from it. Oil prices tumbled that day about 12%. It recovered. It was in the 60s. We're now in 72. And the same we see in stocks, bank stock and bank bonds, came down 1 to 5%. They have recovered since then. So I think the difference with March and Steve pointed it out earlier is in March we have consecutive days of prices coming down across multiple asset classes. In this case, it was just on one day and then a recovery following.
Okay, thank you, Fernando. Let's move to the debt ceiling. I think there's news today. I thought the debt ceiling was resolved weeks ago when I saw that it was good till February, but there's news today. Don, can you explain what's going on there?
Yes. So yesterday, last night, the Democrats and Republicans actually agreed on a deal, a procedural vote that Republicans agreed to, which basically just allows them to take the filibuster off the table. This enables Democrats to pass the debt ceiling themselves. There's a change in the way they did this year. Usually what they do is they'll suspend the debt ceiling itself, but this time the agreement requires that the Democrats actually specify a dollar figure that they would raise the debt ceiling by. And so what will happen here is that no Republican will vote for the debt's actual increase, and only Democratic votes will pass it. with a tiebreaker from the Vice President.
All right. So, and when do we expect this? This comes up like it seems like every half year. When do we expect this to come up again? Or is the new bill avoid that?
Yes. So this will happen again next year. So,
same time next year.
We have a whole year to go this time.
Well, yeah. I think this goes well. So it depends on what the dollar figure is. Democrats are probably a little bit skittish. They haven't given out a number. So depending on what the number is, will tell you how far down the road we'll see this again. But we will see this again.
Okay, Mike, can you tell us what the outlook is like on treasuries and maybe comment on inflation, because I'm hearing about that we're in a high inflation environment, yet the 10-year really is just pretty much at pre-COVID levels. Can you talk about that a little bit?
Yeah, and I think also just to take a step back with regards to the debt ceiling, the things that we looked at were the maturity dates on Treasury bills that were maturing at what they call the X date, and then past there into the end of December. And we've seen those yields a little bit higher than other Treasury bills in that maturity range. They seem to be coming back down in line with the other issues now. Now, when you talk about inflation expectations, and when you talk about the 10-year, we saw inflation expectations kind of ramp up at the start of this year, and they've kind of remained elevated, and they've kind of moved. We're probably off our highs there. But and we touched on the 10-year yield, which is currently about 1.5%. If you just went back just a few months, Carl, back into September, you were looking at 10-year rates at around in the mid 140s. So not much has changed on the 10-year. But then when you look at across the rest of the curve, there have been major changes across the curve there. Fed Chair Powell has come out and the Fed was initially talking about inflation being more in a transitory as the economy opens up. He's basically retired that statement. And as you heard Don talk about a little bit earlier, in terms of the Fed purchases of MBS and U.S. Treasuries, their initial target was probably June to end that process. They're probably targeting more towards the end of the first quarter right now.
Can you comment on what does it mean by transitory inflation?
Well, I think the theory was, as the economy started opening up again, I guess at the time there were still a lot of people on some type of unemployment insurance, and as the economy started opening up again, getting people back to work. So you had the supply chains really kind of bogged down. And we talk every day and we look at the economic data, every day and every month. When you look at things like the ISM manufacturing survey, there are, answers there from respondents, and they talk about disruptions, getting raw materials, things like that, which is going to cause higher prices along the supply chain. And I think they were kind of expecting people to get back to work at that point in time, after all these programs ended around the September timeframe. That seemed to not happen. I think people underestimated the labor costs, and now what you're seeing, people are starting to point towards more of a tighter labor market, and you're seeing the labor costs kind of move up. Just this morning, we had the JOLT survey, job opening survey. It's near, I believe, all-time highs of 11 million. So companies are still looking to hire. They can't find people to hire. And once you start factoring labor costs into the equation, that's going to move inflation expectations.
All right, one last question. If there was a crisis, would you think it would impact our ability to deliver U.S. Treasury prices, and obviously affecting almost every other type of bond we price?
No, we shouldn't be impacted. We've been through this last year, and we were not impacted in any way. We have enough in terms of market color to get through that.
All right, moving to Chinese real estate, a sector that has troubled us for a couple of months now. I think we've seen a high number of kung fu bonds issued over the past few years. Fernando, would you kindly explain to the audience what a kung fu bond is and its the reason why it's so popular, or why so many bonds have been issued?
Yeah, so there are U.S. dollar-denominated bonds issued by Chinese institutions. I think the term started just a few years ago, in 2013, after a consultation with 400 market participants. We've seen significant issuance since then, 2013, 2014, between 40 billion to 80 billion. And the latest numbers, I'm not using 2020 due to COVID, but by 2019, the issuance was close to $600 billion. And 70% of all Asia US-denominated debt comes from the Kung Fu bond space. And the main sectors we've seen like issuance is like real estate, land developers, technology, and financials. Definitely the lion's share of this new issuance comes from the land developers, real estate. We've seen about $50 billion in nominal value loss due to problems with distressed assets and distressed debt from some of these issuers.
Okay, thank you, Fernando. Steve, I think you're pricing these. Steve Martin, I think you're pricing these issues. Can you tell me what you've witnessed over the past few months, and really what's happening now? I think there was some news that's saying that they were going to loosen up money supply for these borrowers. But can you tell us what's going on there?
Yeah, the biggest concern has been the Chinese real estate developers. These companies overborrowed to aggressively expand their businesses. China Evergrande is a perfect example. They're one of the largest developers, and they've been struggling to meet their interest payments, and they're on the verge of default at this point. They have a 8 3/4 of 25 that in May was around in the 80s. Now the bond is priced around 20, and they're trading flat. And as far as like market color, we see plenty of market information on there. There's a lot of dealer participants. There are times you may see some lagging in updating of quotes from dealers, and the bid and the ask. You might see that widening out as well. You just have to do a deep dive into each individual security, and then look at that and compare it to the issuer and to the sector movement.
Okay, thanks a lot. I want to remind the audience that you feel free to type in any questions that you might have to the panel. We'll definitely pass them on to the panel. Want to talk a little bit about energy. We did see oil prices drop on Black Friday, and it does affect many of the securities that we price. We saw the same thing during the height of COVID volatility last April. And I think, Fernando, it really affects some of the frontier markets that we price. Can you talk about that a little bit?
Yes. We've seen the similar type of days back in 2014 and December of 2018, I believe, where we see a sharp drop in oil prices and how that correlates positively with the prices of sovereign debt and corporate debt from LATAM countries. I mean, the largest companies in some of these countries are oil producers. Like you can call it the PDVSA in Venezuela. It's 60% of GDP. I know that right now is distressed under default, but just to give you an example, like Pemex, you have Pemex, you have Petrobras for Brazil, you have YPF for Argentina, or Petróleos of Ecuador. Like only these companies have a nominal value of $500 billion in debt. So the impact of oil prices on the sovereign debt and corporate debt is significant. So when we see like in Black Friday, this as oil was dropping, I see bond prices for LATAM, USD denominated debt coming down between 2 to 5%.
I'm guessing these issues are fairly widely held, especially since interest rates are so low in the U.S.
Yes, we have multiple clients owning this debt. Just because of the
Don't
amount
mention
of
their names,
issuance.
Fernando, though. They're probably on the phone, but don't mention their name.
Of course, of course.
Okay, Steve in London, can you comment, is Ukraine, I've seen Ukraine in the news for various reasons, is Ukraine dependent upon oil prices, and can you comment on what's going on there?
Yeah, sure. Ukraine is less dependent on oil prices, but is more focused on being a conduit for natural gas as Russia pipes gas from its gas fields onto Western Europe. There is a fair amount of political tension because of this at present, where there are a lot of troops massing on the Ukrainian borders, with the Russians being perceived by Western political leaders as somewhat threatening in their position. Having said that, Ukraine's local currency debt at present is very stable with this geopolitical overlay at present. For reference, the benchmark 5 to 6 year sector of their local curve is yielding around 14, that's 14%. And if we look back to, say, March 2020, the yields there got out to nearly 30% at the time. So this is, the yields have been a lot more stable through Black Friday and through this recent tensions regarding Russia effectively versus the West by proxy. And as I said, it's more of a gas story rather than an oil story.
Okay, thank you, Steve. Don, I'm going to turn it over to you to talk about the housing market. Home prices continue to rise. Are we hitting another bubble like we did back in 2008?
Well, we don't think so. Unfortunately, I think in the housing market, the perception always drives and has staying and lagging power than the reality actually portends. So if you look at the market over the past year, obviously post-COVID, you did see, if you're looking at either one of the indices out there, so take Case-Shiller, for example, you did see a big bump up in price, COVID last year, and prices trailed out. So we're certainly in the seller's market, and over the summer, as rates kind of rallied heavily, you did see a reduction in mortgage rates, which kind of, pushed up prepayments and drove rates up. Lower rates actually drove applications a little bit. So, but if you look at the market overall, what you've seen is kind of a slight tapering off in pricing. Those elevated pricing that we're seeing from faster prepayments, the elevated pricing in house prices actually has kind of tapered off. But when you look in, as far as bonds are concerned, it's a slightly different story. What you see is those high prices that you saw at the beginning of the year have kind of leveled off and are starting to taper down. I would even venture to say that the fact that the Fed's heavy in the market is actually putting sort of a slight floor. What we have seen, from faster prepayments from last year into this year, we've also seen prepayments slow down a little bit. So, the shorter durations that we were seeing before is kind of leveled off a little bit, but so you're seeing a slight offset there, cash flow versus discount effect, but you're seeing prices kind of come down a little bit, come back to earth. In spec pools, call protection premiums are about, in some cases, are half what they were end of last year and into this year. So we're in this market, we're kind of seeing, we're still elevated, but prices are kind of coming down back closer to normal levels.
And maybe I missed it, but could you comment on prepayment rates? How have they, how have they been doing over this period of time?
Yeah, so as I mentioned, what we've seen, what I would say is prepayments into post-COVID last year were extraordinary. We saw, massive, unbelievable amounts of prepayments. You'd see prepayments in the 50, 60 CPR last year. Now prepayments have kind of leveled off. So for example, Fannie aggregate 3% is about 34 CPR. So they're well off their highs. from where we saw them, but still elevated. So this elevated prepayments continues to, show us, shorter duration in the pool space. It continues to put kind of a flaw in call protection premiums. Even though the prices are kind of coming in a little bit, our faster environment is still making speculative prices fairly on the higher side.
And can you talk about that forbearance program? Is that all over with now?
So for agency products, forbearance is really just a prepayment into the pool. That was something that there was a lot of scare, especially in the non-agency space, about that. It turned out that was not that was more of a 2020 concern. Was not as significant as expected. People were expecting to see things in the 2008 era, but we really didn't see that massive spike. Though there was forbearance, there was a lot of programs to allow people to transition, and it seems that we didn't see the defaults even after the forbearance programs came through. So it turned out that the system that was created after 2008 kind of worked through the difficulties that some people saw. And we would say that the stimulus programs obviously helped keep a lot of homeowners afloat at a time of difficulty.
Okay, thank you, Don. Let's go to the end of LIBOR here. We don't have that issue in the U.S. Because that's not happening till 2023. But Steve, it's happening in Europe. Can you comment on which IBORs are going away and how you're handling that?
Okay, yes. It's going away specifically in the UK. The sterling LIBOR will cease to exist as it has been for a long time on December the 17th. This will transfer into the risk-free rate known as SONIA. It is obviously a widely expected event by the market as participants and also the regulator and the authorities involved with this transition. The spread differentials between the old LIBOR rate to the new reference rate have been widely published. They are well known. Market participants are generally speaking using the new reference rates as a base for quoting on both floating rate notes in fixed income and derivatives as well. As far as we're concerned in evaluated pricing, there are likely to be, we think there are less than 100, no, we know there are less than 100 outstanding deals where no fallback language has been inserted into the terms and conditions, and the content team are working on that as we speak. In terms of Europe, the European equivalent onshore is called Euribor. This is not being discontinued. It is perceived that the European retail mortgage footprint is too large to try and transition away from their equivalent of a LIBOR, and that will continue as what I would call a business as usual basis. Lastly, I would just add that there are a couple of other LIBORs that are being wound down this year. They are the London-based yen LIBOR. That is also quite a small footprint and has no impact really on what we do. Lastly, the Swiss are moving away from a LIBOR-based reference to what they call a SONAR, their overnight equivalent-based reference, and that is quite an aggressive program where everyone has to have fallback written into their contracts. As you were saying rightly, the US dollar market is deferred until 2023, but I believe the suggestion from the Derivatives Association is that no new LIBOR contracts be written after the end of this year.
You use swap rates as benchmark rates to discount corporate bonds. What's happening there?
The swap rates are, again, the transition rates are being applied. So if you have a legacy contract which involves a LIBOR, there will now be a synthetic LIBOR published where the established spread rate is applied to the overnight equivalent rate to give you the compound equivalent of what the LIBOR would have been. So there is a synthesized version going forward for existing deals to be maintained.
Okay, thank you very much. Moving on to our last topic of the webinar is the holiday schedule this year. A little unusual. We have Christmas Eve 12/24. Most of the markets are closed except the UK, and then there's no holiday in the US for no market holiday in the US for New Year's Day. So, but some of the other markets are closed. Steve, can you comment in the UK being open on 12/24? What are you expecting on that day? Are you expecting a very quiet day, or you think there could be some volatility?
No, we'll be expecting a quiet day there, Carl. It is a standard practice for both the bond market and the stock market to be open on Christmas Eve for the morning, the 24th. They will wind down and they will officially close the stock markets by 12:15. And that is when the bond markets will take their end-of-day mark at that point as well. It has been this way for quite some years, and I would expect it to be, all things being equal as we stand, it to be a very quiet day. On the trading floors, for example, it is a day when people bring their kids in just to see where dad works or where mum works. So it's pretty much a social day for those who have to come in and let the partner deal with the preparation of the food and the wrappings.
And as you know, I'm very jealous that we don't get a Boxing Day over here. Mike, normally when Europe is open to some extent, the Treasury futures market is open, at least the electronic futures market. Is that happening on 12/24?
Yeah, Carl, that is not happening. Globex trading is closed on that day.
Okay, so we're pretty much expecting on 12/24, even though we do release price files, that nothing is going to change.
Correct.
Okay, can you talk a little bit about what time we're cutting prices on the 23rd? Because I see an early close there, and on the on New Year's Eve, 12/31.
Yeah, so on December 23rd, we have an early bond market close at 2 p.m. And stocks are open normally on that day. So we anticipate doing 1 o'clock cycle, so 1:45, and then the normal 4:45. And we'll have the same dynamic on New Year's Eve, the Friday, December 31st.
All right, thanks, Mike. So yeah, we as a pricing service, we deliver files on every business day, regardless of holiday. I think that ends our panel discussion, Christina. I'd like to maybe turn it back to you. Maybe you could give a recap of what we discussed.
Sure. Thank you, Carl. Thank you, panelists. Yes, Carl, I did not see any questions during the session. However, I would like to take a few minutes here just to give our audience an opportunity to post questions in the Q&A chat box if there are any. And of course, if you don't have any at this time, our clients know how to reach us, so don't hesitate to reach out if you want to have additional conversations around the topics we discussed today. So again, to recap what has been covered for COVID. Although the new variant caused volatility, markets have rebounded. Governments are committed to support financial markets during volatility, and prices and yields will be fluctuating, especially during thin markets. For the debt ceiling, this is scheduled for February 2022. Action is needed before December 15th. This was an update we heard about last night. The Senate reached a deal on the debt ceiling. Republicans have agreed to a procedural vote that will enable the raising of the debt ceiling with Democratic votes alone. Rates for the U.S. Treasury that's maturing in December may be volatile, and market is absorbing changes at the Fed. And at the Fed, there's expected changes in leadership and monetary policy. And then lastly, expected U.S. Treasury volatility regarding issues maturing around the X date of the debt limit. For the Chinese real estate, Kung Fu bonds have flooded the market over the past 3 years. The Chinese real estate developers have overborrowed, and the pricing service continues to observe an adequate number of broker quotes to cover this market. For energy prices, this will affect all markets, especially the LATAM, which are highly dependent on oil production. Ukraine is less dependent, but serves as a conduit to Europe, and there are currently political strains. As Steve had mentioned, however, Ukraine currency is stable. For home and mortgage prices, benchmark treasury rates were a driver of historical low mortgage rates, although rates are slightly higher than the 2020 COVID-related lows. Lower mortgage rates were a primary driver of historically significant prepayments, although off 2020 highs. Continued elevated levels of purchase and refinancing supported higher home prices in most markets. In pool pricing, fast prepayments and shorter durations offset discount effect from lower rates as prices and the year lower compared to 2020. And lastly, call protection premiums are also off of their highs due to declining prepayment activity. For the LIBOR cessation, U.S. is not impacted until 2023. Some of the EMEA IBORs will end, and most floating rate notes have fallback languages. And then lastly, synthetic LIBOR rates will be available going forward to use as benchmarks. Holiday calendar, as Carl mentioned earlier, UK is open on December 24th. There's no U.S. market closing for January 1st or January 3rd, I should say. December 23rd and December 31st, U.S. 3 p.m. file will be snapped at 1 p.m. and 4 p.m. file will be snapped at normal 4 p.m. So in addition to the recap, for our clients' reference, the pricing service does provide daily market updates where we share our daily perspective, including color and market observations. And especially, an example at the height of volatility last year, we also provided intraday updates to our customers. This is sent to all of our existing clients. And if any clients in attendance today are interested in being added in the future into the distribution, please don't hesitate to reach out. In the appendix in the slide, actually, I've added some resource links and the links that are relevant to today's agenda topics. We, the pricing service, have written blogs and white papers, and this is hosted in our Refinitiv Market Insights landing page. We also have a dedicated reference rates transition site, or the LIBOR cessation site, as well as the big conversation episodes covering COVID. Lastly, for early closing notifications, aside from signing up on myrefinitiv.com for notifications, you can also reach out to your assigned Refinitiv or LSEG sales and account management team coverage, your assigned customer success managers, and as well as your asset servicing consultant teams. So with that, to our clients, I hope the Refinitiv Evaluated Pricing Service team has provided you with insightful perspectives today behind our valuations process as we are closing out 2021. We do hope to conduct more webinars such as this in 2022 and are very much looking forward to our clients' feedback on today's webinar. So again, thank you to the clients, to Carl and the rest of the panelists, and all of the other attendees for joining us today. Thank you for your continued business, and we all wish you a happy holiday and a happy new year. Thank you all. Goodbye.
Thank you.